If you are a little bit confused about how we account for transactions into and out of inventories, this video will explain the two major methods we use. Not all companies have inventories. Typically, about half of listed companies have inventories and about a half do not. Wesfarmers has inventories of many billions of dollars and Ryman Healthcare has none. In our unit, everyone's firm should have inventories. Check now to see that your firm does have inventories. If your firm does not, please contact your unit coordinator. For companies that do have inventories, they can be a significant part of their business, as it is for Wesfarmers. Cost of goods sold can also be a major expense for businesses with inventories. Before we can look at how we value inventories, which we will look at in another video, we first need to consider how we account for transactions into and out of inventories. There are two key methods for recording transactions into and out of inventories: the perpetual method and the periodic method. The perpetual method is by far the most popular. The perpetual method keeps a record of each purchase of items into inventories and also each sale out of inventories as it occurs. That's right, each and every day. Technology has made this a much easier process to do in practice. It also has the great benefit that it allows the cost of goods sold to be constantly recorded as a firm makes each sale. This means a firm can calculate its gross profit, sales less cost of goods sold, on a real-time basis as it makes each sale. On the other hand, the periodic method only measures inventories and calculates cost of goods sold periodically, not in real time. We do this by physically counting each item of stock at the end of each period. As we do not record each transaction of inventories as it occurs, under the periodic method, the only way we know how much inventories we have is by counting them at the end of each period. For firms using the perpetual method, we still typically do a stock take at the end of each period as a check on the amounts for inventories in a firm's accounts. These may be different, most often more, to what is actually on the firm's store shelves and warehouses because of theft, usually by staff and customers, and wastage. When we record the transactions into and out of inventories using the perpetual or periodic method, we also need to value inventories in dollar terms. We will look at how firms do this in another video on cost formulas. When you study Act 19061 Advanced Financial Accounting, you will need to have a strong understanding of the perpetual method of accounting for inventory transactions. For further information on the perpetual and periodic methods, go back to Chapter 4, Section 4.2 in the study guide, and also review the Inventories Weekly Questions. Also answer, write, and rate questions on inventories in Peerwise.